Marin Katusa's new book, The Colder War, is now on bookshelves. Marin pulls away the curtain on how Russia, China, and Iran have come to dominate the global energy stage and put the petrodollar to rest once and for all. Find out why Dr. Ron Paul and critics alike are calling The Colder War one of the most important books you will read this year. Visit PalisadeRadio.com and enter our weekly drawing to win a free signed copy of Marin's book. That's PalisadeRadio.com.
This is Colin Cattell with Palisade Radio. We're coming towards the end of our free book giveaway, but we still have a couple books left. This week's winner of Marin Katusa's New York Times best-selling book, The Colder War, is Rex from Houston. Congratulations to Rex and all the winners, and thank you to everyone who signed up thus far. It's been a major success. And moving on to our discussion, on the line with us today is returning guest Mike Swanson. Mike's the publisher of WallStreetWindow.com. Mike, thanks for coming back on the show.
Oh, thanks for having me. It's good to talk with you again.
You know, I was just down in the Bahamas spending a few days with our good friend David Skarica, and he mentioned I should get you back on the program. So here you are on the show, and there's plenty going on to discuss. Right now I'm looking at the homepage of your website, and some of the headlines read, Fed meeting will be meaningless, fracking is a $500 billion debt bubble, and Jim Cramer says to ignore the bear market. So I'd love to hear about Jim Cramer, but we're going to stick to more meaningful topics today. What should we talk about first?
Well, if you want to, I could say a little bit about what's going on in oil and why it's dropping, if you'd like to start there.
Yeah, let's start with the oil.
Okay. Well, it's quite amazing if you see what oil, the price of oil has done just over the past 2 or 3 months. Oil was $105 a barrel or above that in June, and now it's hanging around $55 as we speak. So you're talking about almost a 50% haircut in the price of oil. But you got to think too that oil is probably the most important commodity in the world. Everything we do is based upon oil, basically. I mean, driving, if you go to the grocery store, the food you're buying has been delivered there. The oil's used to grow food, of course. It's just used in everything we do. So here's the most important commodity in the world that's cut in half. And if you look, interesting enough, in September, the oil stocks went into a free fall before the month of October came. I know we've talked a lot about gold stocks together in the past. In gold stocks, of course, they dropped really sharply in September also, but the oil stocks really did too. And oil stayed above $90 a barrel, and then October came, and bam, the free fall in oil really began. And I think oil is actually in the same sort of position that gold was in, and the mining stocks back 2 years ago in 2012. In other words, I think this is the start of a bear trend and not the end of one when it comes to oil. I've gotten lots of emails from people asking if they should buy oil stocks because there are huge dividends to be made, or as long as they're not cut, which of course they will be. So it's very tempting for people to jump in the oil area, and it's an area I do plan on investing in one day in the future. But there's 2 reasons I think that it's going to take at least a year before we see the start of a turnaround, and it could take 2 years or 3 years even. And one reason is if you look at the Commitment of Traders report and how people are positioned in the futures market, and you look at this over the what's happened this year and compare it to a decade or 15 years even beyond, you'll see some very interesting things. First of all, you'll notice that the commercial traders inside the oil market built for themselves a record short position in the summer. And then at the same time, the small speculative traders who tend to be wrong at important market turning points did the exact opposite. They built themselves a gigantic long position ahead of the drop, and they've even added on to that long position over the past week, trying to guess a bottom. So from a contrarian standpoint, what the little guy is doing should alarm you and make you cautious about trying to get into oil or oil stocks. What's fascinating to me, though, is that the commercial players, and these are giant players that they may produce oil. They use oil contracts to hedge real world activities. They built a record net short position in the summer. What that means is there are people in the oil market, insiders, you may want to call them. I don't know who they are. We can, of course, speculate, but whatever the case, there are definitely people positioned for the drop, and that's just a fact. That's not to say the price of oil was manipulated lower. These people manipulated lower, but they definitely had the foresight and knowledge lacking among me, you, or just the general public, or these little traders who even know less. So that's what happened. Now, and if you read news articles about this price of oil, you'll see that OPEC has not decreased production. They had a key meeting about that about 6 weeks ago, and just this morning there was a headline, or maybe it was yesterday, but there's another headline saying that Saudi Arabia is not going to decrease production anytime soon, and they even don't care if it goes to $20 an ounce. What's interesting is that meeting 6 weeks ago, the Saudi representatives said that they want oil to drop in order to devastate the American fracking industry that was in the news, the past couple of years. These are oil companies in the Midwest, in the United States, and up until this summer, there's talk that because these oil companies are producing oil, the United States is going to be energy independent, and we're going to be exporting oil, and it's going to eliminate our trade deficit and fix all the debt problems, and basically, do a lot of good things for the country. Well, Saudi Arabia decided that's not going to happen, and they've targeted the American shale oil industry and the fracking industry basically, for destruction, cut it probably in half or something. And the problem is there's a lot of these companies that produce oil at $70 a barrel, $80 a barrel, much higher than the current level, and they're simply going to go bankrupt. So I think that's why people got to stay away from energy stocks and just let these trends play out. At some point, the price is going to bottom. OPEC will cut production, but that's going to be a great opportunity. But we just got to be patient for it.
Well, you bring up a very curious point, and I don't know exactly what to make of it. All the commodities started this bear market 3 years ago. Oil did not take the plunge. However, a lot of these Canadian junior explorers and small producers have been hit as badly as the gold stocks when oil was at $100. So this could be setting up for a really good trade. I haven't followed these little stocks since the oil started pulling back, but I can only imagine they're even worse at this point. It could be a huge trade in the next couple of years.
Well, one of the things about the oil stocks and why they drop so much, like you said, what's interesting is that if the price of oil kind of topped out a couple years ago at $120 a barrel, in fact, in 2011, and basically it went sideways up until now, and it's of course rolling over and it is basically in a decline. But it went sideways for 3 years essentially, while at the same time oil stocks as a whole went up. And one could argue that if you look from 2012 up until this summer, for example, the XLE Energy Select Spider, the ETF for the energy stocks, it went from $65 in December 2012 up to $100. That's a really big gain. And then at the same time, oil prices did not advance. So I think we got to ask ourselves, why did that happen? And there's two possibilities. One is that people just got so excited about oil and believed it was going to go up that they bought the stocks in anticipation. What they were anticipating, of course, did not happen, and therefore they are forced to liquidate. The other possibility, which I think is the real more important one, is that if you look at the American stock market, it's simply overvalued. If you look at things such as the PE ratio, the cyclically adjusted PE, and so forth. And I don't. There's not very many people that deny that. What the bulls argue is that, yeah, it might be overvalued, but interest rates are zero, and because stocks pay dividends, that makes them worth more. That's what people a lot. There was a lot of talk of arguments like that, 6 months ago and last year, 2013, and I think that in effect from in 2013 there was a lot of buying of stocks for the dividend, because interest rates are zero, the stock market's going up, and so forth. And I think a lot of that money simply flowed into energy stocks. People, I think, just chase them because they pay dividends. They're obviously, companies that make money for the most part. But one result of that is just like the United States stock market as a whole, oil stocks became bubbles. And if you look at, for example, just Exxon, Exxon is trading right now, even though it's declined from above 100 down up to where it is now, 94. So you're talking about over 6% decline. But even with the decline, Exxon's trading with a PE forward P of 16, price to book ratio of 2, and a PEG ratio of 3. And that's really the biggest, most important oil company. And if you go throughout the sector, you can find lots of stocks that they're not going to go bankrupt, but they're at high valuations. And now we've got all the stocks, these, that are on the margins because, they're not profitable right now, that can go bankrupt. So you have a sector overvalued and with many individual stocks in it in financial danger. So it's pretty nasty combination. And we saw, what can happen when a commodity drops in price to the more companies on the margins. If you look at the metals market, just the decline in gold from 1,300 to below 1,200 caused a crash in the mining stocks this fall, because the average price of production is around $1,200 an ounce. And there are a lot of companies that produce lower. They're in a great position, but there are also companies that right now aren't profitable, and their stocks, are under pressure as a result. So I really think oil stocks are in the same position that gold stocks were in 2012.
When the equities market pulled back, 2008 is a perfect example where we had the crash. There's some type of a trigger. Things are certainly frothy right now, and you said most people will agree with that, but they're still piling in. Is it possible that all this oil money that's gone in, I mean, there was so much debt going into these oil wells at $90 a barrel that just simply are going to have to go offline now. Is that big enough to take these equity values down, or are you looking for some other type of event in 2015?
I'm not really sure. I mean, if you look at the bonds, the corporate bond market, it is quite interesting in the sense that since October, we've seen Treasury bonds go up in value. In fact, just yesterday, the TLT 20-year Treasury bond ETF made a new 52-week high. So interest rates are dropping. However, at the same time, the yields for corporate bonds are going up. A divergence is taking place, and I think it's due to the stress in the corporate bond market, thanks to the oil industry. The yield on the junk bonds for these fracking companies has gone up from 6% to 8%, and that is something that could definitely, that's a trend that will impact the stock market if it continues, because one of the things that has helped the stock market is the fact that many of the large cap stocks are issuing bonds to borrow money and using the proceeds to buy back stock, which takes shares off the market, helps the value of the stocks go up. So if interest rates for corporate bonds continue to go higher, that's something they're not going to be able to continue to do. So yeah, it is a direct threat to the U.S. stock market if what we've seen over the past couple months continues next year, and I think it will.
Okay, fair enough. And last time we spoke, I guess it was closer to the summer, you said the gold stocks were at or near a bottom, and I think you said you'd gone in pretty heavy at that point. Of course, things have remained bad, and there's been a bit of a sell-off still. At this point, I was joking with David last week that we've just become totally numb to these drops, and at some point things are going to turn around. What are you seeing on the gold stock front right now?
Well, one thing about one thing about gold is in the mining stocks. You just look at gold, and I think this is what people should think about stocks right now. So, if you look at gold, though, I've been someone that's been bullish on gold this year, and thought that if we got above 1350 or so, back in June, if we got by 1350 by now, we would be blasting off into a brand new bull market. And with the mining stocks, the level back then was 250. And of course, gold didn't break 1350 and went lower, and so did the mining stocks. However, when it comes to gold, there are, besides the people that were bullish like me that were proven wrong, there are also a lot of people bearish on gold that have been predicting gold to fall to $1,000 or $900 or $800 an ounce. And I believe these people have also, interestingly enough, been proven wrong by the drop that took place, because we broke through $1,200. And if you look back to 2012, when gold broke support, then it basically broke support at 1550. It crashed within a couple months down to $1,200, and that support level of 1550 was in place for roughly a year. So now this fall, when gold broke $1,200 an ounce, which was another year-long support level, a lot of people were thinking, oh, it's going to drop again like it did in 2013, and they're thinking $1,000, $900, $800, a crash. It didn't happen. So the gold bears actually got proven wrong too. And I think at the moment, we probably should look at the mining stocks the same way, in the sense that here we have the HUI, which basically crashed this November, and it rallied 20% up to 180. Then it came back down to 150. Now it's in between those two levels. And a lot of people are thinking, well, we're going to go through 150 and then go down to wherever they think. And then the bullish argument is we break 180 and then just blast off. And I think for the time being, I don't know if it's going to take probably, maybe a couple months. I think my guess is we'll just kind of remain in between those two levels, with people who are bullish, bullish too early, and people who are bearish simply mistaken.
What's the strategy at this point to just acquire, the best prospect of the gold stocks and just hold?
I think so. I think that's the thing to do. And the kind of stocks I like are ones that have low valuations, which of course most of the mining stocks do at this point, but also have high earnings growth prospects for the next couple of years, and produce gold at already a profitable level. So those are the kind of things I'm looking to accumulate. And I'm not so much interested on the ones that are on the margins that aren't producing for profit, and not interested in ones that really don't have great earnings growth prospects. If I want to invest just in mining stocks as a whole, then the simplest thing to do is buy, one of the ETFs, GDX, GDXJ, and just hold that I got a position now. If I want to buy individual stocks, I think you really are best to be real selective, and really just look for the best ones. They're going to be the ones that go up the most anyway.
Let's finish off with a discussion on the Federal Reserve policies. And I don't know at this point if you really see much implications of the end of QE and holding back the interest rates at or near zero. What effects do you see in 2015? If there's some type of a significant market pullback, do you see the Federal Reserve going back to QE?
Well, the latter, right now, I think the Fed, if you look at the comments that have been made over the past couple months, the drop in October was really interesting, because the stock market pulled back really quickly in the space of 2 weeks. And on television, the CNBC economist Steve Leisman they leaked a story that if the market continued to decline, that the Fed would eventually do QE again. Basically, they said if the market continued to fall for several more months, then QE would be something, another QE would be something down the road. So they've already kind of said that they'll step in again. Now, for them to do that would take a market decline more severe than what we saw in the middle of September. And I think, for various reasons that we're likely to actually see a big market pullback next year. And so I think there is a chance that at some point the Fed will do more QE. However, I don't think that's an argument or a reason to not be cautious about the stock market, because a lot of people think, well, if the Fed does QE, they'll make the market go back up, or they've made the market go up for the past couple of years. They're just going to keep doing it forever. But I think that assumes that they have the ability to do that and manage things perfectly. And if we ever get to the situation where the Fed decides it wants to do QE again, and people think, well, that's going to make the market go up. The problem with that is that if we ever get to that point, nobody knows how much money the Fed would have to print to stop a bear market once it gets going. And they're very unlikely to just, print $1 trillion or some ridiculous amount of money. And I don't even know if that would do it. And that may sound really kind of extreme, but if you think back to the last two bear markets, the Fed lowered interest rates, which is much more powerful for the economy than quantitative easing. And, it took a year and a half of lowering rates in the last bear market to put in a bottom. And in the 2000 bear market, there wasn't a bottom for 3 years, during a time in which the Fed was lowering rates month after month. So just to put faith in that and say, I don't have to risk, I don't have to worry about risks anymore, is a very dangerous proposition. Right now, yes, the stock market today is the S&P is at a new 52-week high, but I think we're in the latter phases of a bull market, which is likely to become a bear market next year. The most important reason now being that the internals of the market are lagging badly. The market averages, the percentage of stocks that are going up with the market on these rallies is diminishing every month, and has been doing that since July.
Mike, thanks so much for taking the time today. I actually just went to your website while we were on the interview, wallstreetwindow.com, and signed up for your free newsletter. I've been getting some of your material for some time, and it's great insights. So I encourage all of our listeners to do that, and thanks a lot for coming on the show again.
Yeah, thank you.
Vladimir Putin is a self-made man. He did not come from money. He did not come from a royal family. He was your blue-collar boy who did well. Putin has positioned himself in the center of the chessboard, in the energy matrix of the world. Right now, Putin and his allies in China, India, Brazil, all of the emerging markets are aligning together to fight the European Union, the IMF, and America. Eventually, the rest of the world will realize that Obama and America are hiding behind this curtain with no powers anymore. Putin specifically has positioned Russia to become a global superpower, and America has never been more vulnerable than it is today.